Okay, so for those of you who just joined, this is the recognition criteria for revenue, right? You have to identify a contract, either legal or constructive. You have to identify the performance obligations that each party are supposed to do. Then the price, which is the money aspect of the contract. You allocate the price to each obligation, okay? And when the obligation is performed, then you can actually recognize the revenue to that obligation. So if the obligation to that price has not been performed, you cannot recognize it. If it is not performed in the accounting period we are preparing the account, then it will belong to the next accounting period. All right, so that is that. You need to check that. Recognize only those obligations that has been fulfilled in the reporting date. All right, so that is that. So let's move on to the contract aspect. Okay, when it comes to this aspect, the only way they can test you is what I've already mentioned to you: the agency, sales with warranty, sale or return, repurchase, bill or hold. All right, so all those things. Now let's look at the contract part. And I'm going to give you a four-step approach to contracts. Here we are talking about construction contracts. All right, how do you recognize sales from these construction contracts? The first thing you need to do is to determine the overall P&L. So step one, determine overall P&L. Okay, you have to determine the overall P&L. Why are you doing this? To determine if projects or contracts, let me use contracts, to determine if contracts is profitable. Don't forget that if contract is not profitable, then you will straight away make a provision. It's a one-loss contract, okay? Remember, IFRS 37, one-loss contract. A contract that you know that you are going to make a loss. If you already know that you make a loss, then you provide for it, all right? So that is what it means. I will later point out how you are going to recognize that loss, because if you know you are going to make a loss, then the loss now becomes unavoidable cost, okay? Because you've signed for it, you have an obligation to it, and therefore it becomes unavoidable, and therefore you have to recognize a provision. The measurement for that one is actually the lower of the cost of fulfilling that contract, which you already know that you are making a loss, or the cost you incur in terminating the contract plus any penalties from terminating it. Okay, whichever is lower is the one that you use. I'll describe that thing on your screen for you to see. But for the meantime, if you have the contract, you have to determine the overall P&L to determine whether it's profitable or it's not. If it is profitable, how will you know? So you will need the contract price. That is the price of the entire contract. Then you will have to less cost to date. These things that we do now, they are actually things that we did in senior high school, if you guys remember. These things are things that was done in senior high school. Those of you who did cost accounting, all these things were done in senior high school. So you will add cost to date, the cost that you have incurred so far, then the estimated cost to complete. All right. So you will have your overall P&L. That is what you have. All right. Sometimes this cost to date may include some carrying amount of plant assets that you purchase. All right. They may include that. Okay. I saw a question like that. They bought, because of the contract, they bought a plant. And as a matter of fact, that plant become a contract cost. And at the same time, you realize that when the contract is finished, it will be owned by the entity. So they will have a PPE. So that is that. So this is how you determine your overall P&L. Now, this one is to help you if the contract is a profit-making contract or a loss-making contract. If it is a loss-making contract, like I said, if it's a loss, you have to provide for it immediately. All right, you have to provide for that loss immediately. All right, so that is that. You now need to go to your step 2, and your step 2, what you are going to do is to determine the progress of the contract. Determine progress. We have 2 methods of determining progress. One, we have the input-based method. And if you want to use the input-based method, the question will show you, will ask like, or tell you which method they use, okay? You have to use the input-based method, then it is a cost method. So you will need cost to date. Where will you see your cost to date? This is your cost to date over the total cost. What is your total cost? Is this one plus this one. All right, that gives you your total cost. Okay, so that is how you determine it. All right, so you have a percentage of your progress. All right, now with the other method is the output method. And how do you determine that? You will need work certified all over your total revenue. The work certified will be mentioned for you in the question, and you will need your total revenue, which is the contract price. All right, so this one is revenue, this one is cost of sale, kind of. All right, so that is that. Now, step 3. Step 3, what you see under step 3 is to prepare the statement of profit or loss for the current year. All right, this one was to determine the overall. This one, you are preparing it for the current year. All right, the year in which you are preparing the financial statement. And you can only do this if it is profitable. If it is not profitable, you don't go through these steps. You recognize the loss immediately and you are done. All right, now here we will need, as usual, our revenue. And what is our revenue? Our revenue is equal to what? The contract price we have here. Okay, and since we are looking at a 1 year in perspective, you will have to multiply it by your progress percentage. You see this one that you will be getting. All right, you will have to multiply. So the contract price, which is the general amount, multiplied by the progress percent. Now watch this. What if they give you the progress percentage up to, let's say, from 4 years up to 5th year, they give you the progress percentage. Then it means that if you want 1 year in perspective, we need to now go back and less the 4 years from the 5 years before you can get this year. Because the progress percentage started from somewhere up to where we are now. All right. So the work you've done, if you finish 60%, probably the 60% that you have finished, you actually started it from 4 years ago up to the 5th year, you have your 60%. And therefore, if you multiply it by the contract price, that sum that gives you is not actually for that year because it has been coming from somewhere. So what you need to go ahead and do is that you need to less revenue from previous year or years. Less revenue from previous years. So that is what you get here. Cost of sales, we are doing a small P&L here, cost of sales. That one too, the same thing. How do you get it? You need to know your total costs. Okay, you need to know your total cost. You need to multiply by what? The same progress percentage. And you need to less what? Prior year costs. Okay, you need to less your prior year cost, just as you do here. So you have your costs, you take off. Then that one will end you up with what? Your profit for the year. For the year. All right. This one was the overall. This one is for this year in perspective. Last step you need to go through and do is to actually go ahead and prepare your SOFP sort of. All right. Your SOFP sort of, because you have your P&L here. And this one is like SOFP. So that one, how do you do it? Here we are looking at the actuals, all right? What has actually happened, the actuals. So you have to recognize, bring in your recognized profit to date, your recognized profit to date. Remember, balance sheet items are cumulative, SOFP items are cumulative. So this one is like retained earnings. You bring it, all right. So you first so then you bring in, so let's start with our cost to date first. So cost to date, you bring in your cost to date. And your cost to date here, like I said, we are actually talking about the actuals, what you have actually incurred. Then you bring in your recognized profit to date. Then if there was a loss, this is where we say you recognize it immediately. This is what we meant, you less it from here. Okay, then if there is any receivables or invoices that you built out, so we say receivables or invoices billed. That one too, you need to less from it. Then you get, if you may get a positive or a negative answer. So if it is a positive, it's a contract asset. You add it to your current asset. If it is negative, as you see here, it's a contract what liability. And you also add that one to your liability component. So this is how the construction aspect looks like. Okay, that is how it looks like. Yes, any question? Because I'm done with IFRS 15. We just need to solve questions now. Any question? Any question? Please ask questions too. It's very, very important. So you need to try and take these formats to head. Okay, you need to get it in your head. It will help you score some marks. But any question, please? So if there is no question, then I need to test you. So where is my manual? We've defined all these things. We talked about the 5-step approach. Okay, so let's look at this for testing the theory base. So we have on December 1, Mr. Febedu, who is a pastor, receives an order from a customer for a computer as well as 12 months of technical support. Okay, so there is an order for a computer and a 12 months technical support. Febedu delivers the computer and transfers its legal title to the customer on the same day. The customer paid $420 upfront. If sold individually, the selling price of the computer is $300, and the selling price of the technical support is $120. That makes the $420. Now we are asked to apply the 5 stages of revenue recognition per IFRS 15 to determine how much Febedu should recognize in the year ended 31st December 2020. Remember, this is the date everything happened, okay? And the person has been given 12 months repair or technical support. So yes, who has an idea? Let's go through this together. Per what we did, what are the 5 steps? What are the 5 steps, please?
We have copper.
Yes, the copper. So how can we use the 5 steps in this to solve the question in this case? So
the first one, the C, we have to identify whether there's a contract in this arrangement.
Okay, so C, is there a contract?
I think so.
Yeah. So you have to state it there. There is a contract because he has received. Yeah, he has received and he has also delivered.
Okay.
Yeah, so there is a contract. Okay. So you explained that. What is the next one?
We find the performance obligation.
Yes, so what are the performance obligations here?
One is to deliver computer.
Yeah, so we have.
And the second one is to the technical support for 12 months.
Yeah, so we have the technical services. And it's good you said it's 12 months. Well, what is the next thing?
Determine the price.
Look for the price.
Yeah, so what is the price? The price is for
the price. The price
is how much? What is the value of the price? Guys, what is the value of the price?
420.
420.
Yeah, 420 cedis. What is the next thing?
We now allocate
Allocation, okay.
the price to the performance obligation.
Okay. So these are the obligations, right? So
yes.
The computer and what? The technical support.
Yes.
Support.
Okay. So the computer is how much?
300,000.
300.
300.
And we have here 120.
Yes.
Okay, so how much should we be recognizing? R is for recognition. So that is
divided by 12 months.
Which one?
120 divided by 12 months.
Okay, 120.
120 divided by 12 months.
Okay, that one gives us 10.
Yes.
Yeah.
Okay. Is that all?
No.
And then the 300.
Yeah, because that one was delivered.
Yeah.
So it means out of this, the amount we can recognize as revenue is what?
310.
310. Have you seen what we've been talking about? So in your question, if they bring it in a publication where they try to give you a story around it, you have to determine the part that has it. So it means that the remaining 110 out of the 120 will have to be deferred into another year. That is what it means. As for the year in perspective, we are able to only do an obligation, perform the activity that will give us only 10,000 or 10 here in this case. Okay, so that is how it is. Okay, so whatever question they give you and they tell you to apply these 5 procedures, you should be able to single those things out and deal with it. It's as simple as that. It's as simple as that. So you see that in terms of the agency that I spoke about, if you have not performed the agent's job, you can't be receiving the commission to it in that effect. So that is what we meant by that. All right, you have answered everything. And this is the answer that you have provided me. So 10 and everything. Yes, any question? Any question? Yeah, so that is the approach you carry on with all the questions. I spoke about principal and agent. I spoke about warranties and all those things. All right, so you are good about that. Now, what I need to go straight to is to actually test you on the contract. The contract. So all these things are steps that we've spoken about. All right, so let's look at this question on a contract and deal with it peacefully. Okay, so this is it. Illustration 13. Okay. So we said that the following relates to construction contracts. You have your contract price, you have your cost to date, estimated cost to complete, estimated stage of completion. And it says that what amount of revenue, cost, and profit should be recognized in the statement of profit or loss. Okay, so we see our price, we see everything. Okay, so here what we're going to do is to carry on with our 4-step approach. One is a contract. Number 1, we said what? Overall P&L. How do you do your overall P&L? You take the contract price, which is 800,000, and you less what? The total cost. The total cost being cost to date, which is 320, and you have estimated cost to complete, which is 280. Please start punching calculators. So we get our overall P&L. Where is my calculator? Found it here. So you have 320, 280. We are lessing it from 800. So I have 200. So it's profitable. So it's a profit. So if it is a profit, then I need to move on to step 2 and determine progress. Now, if you check this question, it said that estimated stage of progress has been done already, right? So we just slot in our progress. Sometimes you have to calculate it yourself using the input or the output method. Okay, you have to do it yourself. All right, now we are done. If we want to calculate the P&L, okay, if you want to calculate the P&L, this one, the year looks to be just 1 year. So we are good to prepare that one by determining. So we have profit or loss. We don't have any date to it, so we assume this is 1 year. So we determine our revenue by multiplying our total revenue by our progress. Okay, we don't have any previous year to do any sort of deduction. Our cost of sales is also how much? It's 600. The combination of this total cost 600, 60%. All right. So how much are we getting? I think at the end of the day, we should be having 120 because 60% of this is 120,000. So if I do 60% of 800,000, what I'm getting is 480. Then if I do 60,000 by 600, 60% by 600, what I'm getting is 360. So it's correct then. So that is that. That is that. We can go on with our step 4. So we have cost to date. What is cost to date? 320. And what? Recognized profit to date. How much is that? This is what we have. This is the profit that we have. Okay, so I mean, it's just 1 year. So I mean, the profit that we've obtained. Okay, maybe when we do the 40%, you have the remaining in addition. Okay, so that one, this one is just 120. It's 120. Yes, then after that, what next, please? What next? There wasn't any losses. No. There was there any invoice that has been billed or any? No. So we can actually close down having 440. And this one is a contract asset, which will be treated as part of our current assets. All right, so that is that. So that is how you go through. Let's look at a more advanced question that will probably test our mind. So, so this one is school chop.
So, sir, if it had been a contract liability, where would you take it to?
A contract liability, it will go to your current liabilities.
Okay.
Depending on the number of years that are left for the contract to be done, to be finished. It can be current liability or non-current liability.
Okay.
All right. So this is what we've done. All right. These are what I've shown you already. Okay. So do we have time to complete this? I don't think so. Let me pick up. There's a question. So look at this. I need you to think very well about this question. We are going to do this. Okay, so let me go through this with you. Probably when we rejoin, I will now give you a question for you to do on your own. So look at this. So we have a contract. You have to read the question very well most times. AT commenced 3-year building contract during the and said that during the year 31st December 2014 and continued the contract during 2015. So the details are given below. We have contract revenue 45, cost incurred to date 2015 20. We have estimated cost to complete 12, work certified in 2015. In 2015, and you have to be very, very careful about the way they put this thing. So the work that is certified in 2015 is what you have. Then you have stage of completion as at 2015 is what? 70%. Profit recognized up to 2014 is what you have here. Show how the contract will be dealt with in the statement of statement of profit and loss. Okay, I made a note here for you where not profit can be calculated if contract spanning more than one period. It is a loss making, then the revenue is limited to recoverable cost. I mean, this is what I mentioned, so you just move straight away and provide for it. So let me use this short period for us to deal with it. Step 1, overall. So we have the contract value to be how much? Please, what's the contract value?
45.
All right, 45. Cost to date. Remember,
20.
we are doing this thing as at 31st December 2015. Cost incurred to date at 2015. That is where we have here. Is what? 20. Cost to complete, estimated cost to complete, estimated cost to completion, we have 12. Please, when you less, how much do you have? I'm having 13.
Yeah.
Meaning that it is profitable. Therefore, I need to go on to step 2. I need to determine progress. So the progress work certified has been given me. They said that stage of completion at 2015 is what? 70%. They've given it to us. Okay, 70%. So, I mean, we don't need to really struggle. Okay, we have 70%. Okay, then we need to move on to what next over P&L for the year 2015. We will need what? Revenue. And the revenue, this is where the thing becomes very tricky. Do we have any revenue here? So you see, they've actually given us the profit recognized to date up to 2014. The profit up to 2014. Like I told you, you see, when you get here, when we were doing, you can actually know your profit from here. So in fact, if we do 70% times 13, you can know the profit of 70%. So be very, very careful. So let's just work the revenue. So revenue will be what? 70% multiplied by the total, which is 45%. That revenue is here. But is there any revenue coming from previous year? Do we see anything coming from previous year? I don't see. Cost, I see cost to date 2015. I see estimated cost to I see work certified 2015. Okay, so this is the work certified as completed in 2015. In 2015, so I don't think I need to go through all this because they've actually given me the work certified, the revenue with the work certified in 2015 already. So I really don't need to go through the whole 70% times 45. Yeah, so be very, very careful. Read the question well. Work certified as complete, and it is in amount. So I really need not to go through this. I already have my 15. Because I want the P&L for that particular year, and they're giving me work certified. All right, this is the percentage, and they give this percentage is from whenever they started the project, which is 2014, to whenever they have finished up to, which is 2015. But they've given me only 15 for 2015, so I'm good to go. Now, they've never given us any cost. Okay, so we will probably have to compute the cost, but be careful. They've given you the profit of 2014. So it means that if you can now determine 70% on this 13 to actually get the profit to date, so it's 70% times 13, you will actually get profit to date, and you will less previous year's profit to get your current profit. So when I did this, I think I had 9.1. So now, instead of giving us cost to date, they are giving me profit to date. So if I have profit for last year, which is 3.3, and I have profit to date, if I take previous years from it, I can actually get my current year profit. So what I get here is that there is a profit, and it's coming from 9.1 minus 3.3. 3.3. So that one will give me 5.8. And the difference thereof will actually give me my cost of sales. The difference here, so